Imagine waking up one morning and realizing that the future of an entire continent's economy is quietly being decided not by elections, not by headlines, but by something most people never see. Capital flows, liquidity, confidence, decisions being made in milliseconds that will shape jobs, innovation, and power for decades to come. Here's the uncomfortable question no one likes to ask out loud. What happens when opportunity exists, but the capital to unlock it doesn't? What happens when brilliant ideas are born, world-class talent is trained, industries are ready to scale, yet the financial engine meant to fuel all of it simply can't keep up? For years, the assumption has been comforting. Europe is strong, stable, sophisticated. But strength on paper is not the same as strength in markets. And stability, when mistaken for resilience, can quietly turn into stagnation. The world has changed. Capital is faster, more selective, more unforgiving than ever before. It does not wait. It does not compromise. And it does not care about legacy. Right now, trillions of dollars are constantly scanning the globe, searching for depth, for liquidity, for certainty, for markets that can handle size without breaking, stress without panic, and growth without friction. Some regions are absorbing that capital effortlessly. Others are watching it pass by. And here's the tension. This isn't about a single crisis or a single bad year. It's about a structural reality that compounds over time, quietly, relentlessly. While most people are distracted by short-term noise, long-term advantages are being built or lost. Because when capital markets lack depth, everything slows down. Innovation hesitates. Entrepreneurs think smaller. Investors demand more or walk away. Talent migrates. Not overnight, but permanently. And by the time the consequences show up in growth numbers, in competitiveness, in global influence, the window to act has already closed. So tonight, don't listen to this as a discussion about finance. Listen to it as a discussion about power, momentum, and the future. About who gets to fund tomorrow's breakthroughs and who ends up financing someone else's success. Stay with me, because what we're about to unpack explains far more than markets. It explains why some economies lead and why others slowly fade without ever collapsing. Capital markets live and die by depth and liquidity. They are not abstract concepts. They are the difference between an economy that can absorb shocks and one that fractures under pressure. When markets are deep, capital moves efficiently, prices reflect reality, and risk is distributed across a broad base of participants. When markets are shallow, every large trade becomes a disturbance, every shock is amplified, and growth is constrained by hesitation rather than ambition. In much of Europe today, the reality is uncomfortable but unavoidable. The markets are simply not deep enough. Liquidity thins out too quickly. Large pools of capital struggle to enter and exit positions without moving prices. That creates friction, and friction is the enemy of investment. Institutional investors, pension funds, endowments, sovereign capital require confidence that markets can handle scale. When that confidence is missing, capital looks elsewhere. Depth is not just about volume, it's about participation. A truly robust market has a wide array of buyers and sellers operating across time horizons. Long-term investors, short-term traders, market makers, and risk managers all playing their role. When participation narrows, price discovery weakens. Assets no longer reflect their true economic value. Instead, they reflect scarcity of liquidity. That mispricing raises the cost of capital for companies and lowers returns for savers. Everyone pays the price. Liquidity is also what allows markets to function in moments of stress. Volatility is inevitable. It is not a flaw, it is a feature of free markets. But without sufficient depth, volatility turns destructive. A modest shift in sentiment can trigger outsized moves, not because fundamentals have changed, but because there simply aren't enough participants willing or able to step in. That instability erodes trust, and once trust is lost, it takes years to rebuild. The consequences extend far beyond trading floors. Companies in shallow markets depend more heavily on bank financing, limiting their flexibility and slowing innovation. Entrepreneurs find it harder to scale. Public listings become less attractive. Over time, talent migrates to ecosystems where capital is abundant, liquid, and patient. That is how economic leadership quietly shifts, not through dramatic collapse, but through persistent underperformance. Deep markets are not created by chance. They are built through consistent rules, strong market infrastructure, and an environment that welcomes competition and capital formation. They reward transparency, enforce discipline, and allow failure without systemic damage. Most importantly, they give investors confidence that capital can be deployed at scale without distortion. The global economy does not wait. Capital is relentlessly mobile, and it flows toward efficiency. Regions that fail to build deep, liquid markets do not stand still. They fall behind. The choice is stark: invest in market depth and robustness, or accept a future where opportunity is constrained and growth is exported elsewhere. Fragmentation is the silent tax on capital. It doesn't announce itself with headlines or market crashes, but it steadily erodes efficiency, confidence, and scale. When a region operates as a collection of separate markets rather than a single integrated system, capital becomes cautious. It hesitates, and hesitation in finance is expensive. Across Europe, capital still moves through a maze of national rules, regulatory interpretation, settlement systems, and tax regimes. On paper, there is a common market. In practice, investors encounter borders at every critical point of the investment process. That friction discourages cross-border participation and prevents risk from being shared broadly. Instead of one deep pool of capital, the region is left with many smaller ones, each insufficient on its own. Integrated markets allow capital to flow toward its most productive use without artificial barriers. Fragmented markets trap capital locally, even when better opportunities exist elsewhere. That misallocation lowers returns and raises costs. Companies pay more to raise money. Investors demand higher premiums to compensate for complexity and uncertainty. Over time, innovation slows not because ideas are lacking, but because funding is inefficient. Fragmentation also undermines resilience. In a unified market, stress in one sector or country can be absorbed by participants across the system. In a fragmented environment, shocks remain concentrated. Liquidity dries up faster, volatility spikes harder, and policymakers are forced into reactive measures that further distort markets. The system becomes fragile precisely when strength is most needed. Scale matters more than ever. Modern capital markets compete globally, not regionally. When investors can deploy capital seamlessly in one jurisdiction, but face layers of complexity in another, the choice is obvious. Capital flows toward simplicity, predictability, and depth. Fragmented markets struggle to attract global participation, not because they lack opportunity, but because they lack coherence. The cost of fragmentation is not theoretical. It shows up in valuations, in IPO activity, in the ability of companies to fund long-term projects. It shows up in the absence of globally dominant firms in emerging industries. It shows up when promising companies seek listings elsewhere because they need access to deeper, more unified pools of capital. Fixing fragmentation requires more than good intentions. It demands alignment of regulations, market infrastructure, supervision, and incentives. It requires policymakers to recognize that national preferences cannot take precedence over collective strength. Capital markets reward consistency. They punish ambiguity. Without alignment, reforms remain cosmetic and the underlying problem persists. The world's most powerful markets did not become dominant by protecting silos. They became dominant by tearing them down. They created environments where capital could move freely, where risk could be shared broadly, and where scale was an advantage, not a constraint. Fragmentation is a choice, whether acknowledged or not. And in a world where capital has unlimited alternatives, choosing fragmentation is choosing irrelevance. Competitive economies are built on competitive capital markets. This is not a philosophical statement. It is an observable reality. The regions that lead in innovation, productivity, and global influence are the same regions that have built markets capable of mobilizing vast amounts of capital quickly, efficiently, and at scale. When capital markets underperform, economic ambition shrinks with them. Global competitiveness today is defined by speed and scale. Companies must invest heavily and early in technology, infrastructure, talent, and research long before returns are certain. That kind of investment requires capital markets that are deep, liquid, and willing to take risk. When markets cannot support that level of commitment, companies are forced to think smaller. They delay expansion, limit experimentation, and avoid transformative bets. Over time, that caution becomes structural. The difference between regions is stark. In economies with robust capital markets, firms can access equity financing that allows them to grow without being constrained by balance sheets. They can fail, adapt, and try again. In weaker market environments, failure is punitive and capital is scarce. That discourages entrepreneurship and concentrates risk instead of dispersing it. Innovation becomes incremental rather than exponential. This gap in competitiveness compounds. Capital markets don't just fund companies. They shape ecosystems. They determine where talent clusters, where startups form, and where global firms choose to locate strategic operations. When markets are shallow or inefficient, talent migrates to places where ideas are matched with capital quickly and reliably. The loss is not immediate, but it is persistent. There is also a strategic dimension. Nations with strong capital markets can finance long-term priorities, energy transitions, advanced manufacturing, defense technologies, and digital infrastructure without overburdening public balance sheets. Markets share that burden. When markets lack depth, governments step in more aggressively, often crowding out private capital and distorting incentives. That weakens competitiveness rather than strengthening it. The global economy does not reward potential, it rewards execution. Regions may have exceptional universities, skilled labor, and industrial capacity, but without capital markets that convert those strengths into scalable enterprises, leadership remains elusive. Competitive advantage is not declared, it is funded. What makes this challenge urgent is that capital is unforgiving. It moves toward environments where returns are maximized and risks are clearly priced. If markets fail to deliver clarity, consistency, and scale, capital reallocates. That reallocation is quiet but decisive. By the time the consequences are visible in growth data, the opportunity has already passed. Strengthening capital markets is not about financial optics or prestige. It is about ensuring that economic ambition is matched by financial capacity. Without that alignment, competitiveness erodes from the inside out. In the long run, the question is simple: will markets empower growth, or will their limitations define it? Economies that choose the former shape the future. Those that accept the latter watch it unfold elsewhere. Capital does not commit where it cannot move. Investment flows follow a simple logic: opportunity must be matched by flexibility, scale, and confidence in exit. When markets lack depth and liquidity, even attractive assets struggle to attract long-term capital. The result is not a shortage of interest, but a shortage of commitment. Institutional investors manage capital on behalf of millions of people, retirees, workers, future generations. Their mandate is not to chase headlines, but to allocate capital responsibly. That requires markets where positions can be built and unwound without distorting prices. When liquidity is thin, every allocation becomes a risk management problem rather than an investment decision. Capital responds by staying on the sidelines or moving to jurisdictions where markets can handle size. This dynamic has real consequences. Domestic savings are not fully reinvested into domestic growth. Instead of funding local innovation, capital is exported to deeper markets abroad. That is not a failure of patriotism. It is a rational response to structural constraints. Markets either accommodate capital or capital finds alternatives. Foreign investors face even higher barriers. Cross-border investment demands clarity on regulation, settlement, taxation, and governance. In shallow or fragmented markets, uncertainty multiplies. Investors demand higher returns to compensate, or they walk away entirely. Over time, this creates a self-reinforcing cycle. Limited participation reduces liquidity. Reduced liquidity deters new participants. The impact on companies is profound. Without reliable access to capital markets, firms depend more heavily on bank financing or internal cash flow. That limits strategic flexibility and discourages long-term investment. Growth becomes reactive rather than proactive. Companies invest only when they must, not when opportunity demands it. This environment also shapes corporate behavior. Public listings become less attractive when markets cannot support consistent trading and fair valuation. Promising firms delay going public or choose to list elsewhere. That drains the domestic market of high-quality assets, further weakening liquidity and investor engagement. Long-term capital is patient, but it is not passive. It requires confidence that markets will function under stress, not just in calm conditions. Without that assurance, investors shorten time horizons and reduce exposure. That shift undermines the very purpose of capital markets to fund long-duration projects that drive productivity and innovation. Capital markets are ecosystems. Liquidity, participation, and confidence reinforce one another. Break any link in that chain and the system underperforms. Restore it, and capital flows with remarkable speed. Investment does not disappear, it reallocates. Regions that fail to build markets capable of attracting and retaining capital do not just lose funding, they lose momentum. And in a global economy defined by competition for capital, momentum is everything. Reform is not a political slogan, it is a market necessity. Capital markets do not evolve on their own. They respond to structure, incentives, and trust. When those elements are misaligned, markets stagnate. When they are corrected, markets scale with extraordinary speed. The challenge is not identifying what needs to be done, but finding the resolve to do it. Robust capital markets are built on consistency. Investors require clear rules that are applied uniformly and predictably. Ambiguity increases risk, and risk raises the cost of capital. When regulations vary by jurisdiction or change without coordination, capital retreats. It demands a premium or it leaves altogether. Markets reward discipline, not improvisation. Infrastructure matters just as much as regulation. Settlement systems, clearing mechanisms, and market access must operate seamlessly across borders. Delays, inefficiencies, and complexity create friction that discourages participation. In modern finance, milliseconds matter, but so does reliability. Capital flows where systems work every time without exception. Reform also requires a shift in mindset. Capital markets are not zero-sum games between nations or institutions. They are amplifiers of growth when designed correctly. Fragmented oversight and competing national interests dilute that power. Alignment does not weaken sovereignty, it strengthens collective capacity. Markets care about outcomes, not intentions. There is urgency here. Global competition for capital is intensifying, not easing. Other regions continue to modernize their frameworks, deepen liquidity, and attract global investors. Standing still is not neutral. It is a decision to fall behind. The cost of delay compounds over time, quietly but relentlessly. Effective reform must prioritize participation. Markets thrive when a broad range of investors can engage confidently. Retail savers, institutional allocators, entrepreneurs, and global capital alike. That participation deepens liquidity, improves price discovery, and builds resilience. Exclusion, whether intentional or structural, weakens the system. Policymakers often underestimate how quickly markets respond once reforms are credible. Capital is not emotional, it is pragmatic. When investors see alignment, clarity, and commitment, capital arrives. Not gradually, decisively. The same forces that pull capital away can bring it back if the conditions are right. The ultimate goal is not to replicate another markets model, but to build one that functions at scale, supports innovation, and absorbs risk without instability. That requires courage to simplify, to integrate, and to trust market mechanisms rather than control them. History is clear on this point. Regions that commit to deep, integrated, and resilient capital markets shape their own economic destiny. Those that delay reform outsource it. The choice is not theoretical. It is immediate, measurable, and unforgiving. And this is where everything comes into focus. Because the future will not wait for hesitation. Capital will not pause out of loyalty. Markets do not reward potential. They reward preparedness. And in the years ahead, the gap between regions that can mobilize capital at scale and those that cannot will grow wider, faster, and more unforgiving than most people expect. This is not about one policy, one reform, or one market cycle. It's about momentum. Once capital decides where it belongs, it reinforces that decision again and again. Liquidity attracts liquidity. Confidence compounds. Opportunity accelerates. And on the other side, absence becomes permanent. The real risk is not collapse. It's irrelevance. It's waking up a decade from now and realizing the world's most transformative companies were built somewhere else, funded somewhere else, listed somewhere else. That innovation didn't disappear. It simply followed the path of least resistance. And here's the truth few are willing to say, clearly the window to act is narrowing. Every year of delay raises the cost of catching up. Every missed reform strengthens competitors. Every fragmented rule, every shallow pool of liquidity quietly votes against the future. But the story is not finished. Markets can change rapidly when leadership clarity and courage align. Capital responds instantly to credibility. When depth is built, money flows. When liquidity returns, confidence follows. And when confidence takes hold, growth becomes exponential. So the question isn't whether the future will be funded. The question is where. Who will have the market strong enough to carry ambition? Who will have the courage to remove friction instead of defending it? And who will look back and realize the warning signs were clear long before the opportunity was gone? If you want to understand where the next decade of power, innovation, and wealth will be created, this conversation is only the beginning.